What's up, traders? How we doing? Welcome to Trade Flare Tips and Tricks. This is where we do small videos to answer some questions that we have in the Discord, or whenever we feel the need to make a short video to explain something specific that has been going on or something that we want to teach everybody in the Discord. So for today's video, we're going to be going over something that could be really useful as we head into these big earnings this week. Now, before we do any calculations, we probably should understand something called implied volatility. And the way I like to think of implied volatility is, say you buy an insurance claim, car insurance, and you are a 18-year-old kid that's already crashed his first car compared to a 35-year-old person with a clean driving record. That risk that is going to raise the premium on your insurance. If you were the kid that already has been in the accident, it's very similar to the word implied volatility. It's like an option pricing in risk of something that could actually happen. So as stocks approach major events or as they go on major bull runs, they have implied volatility built up into them. And that means that the sellers of each side of the option chain are saying, hey, pay me a little bit more because there's a lot more risks that, both of these scenarios could actually happen. So earnings is usually the biggest booster of implied volatility. So we have to figure out how much implied volatility and then how much is this option chain pricing in for the weekly option. So we're going to use an example here, and I'm using TD Ameritrade's Thinkorswim, and I'm looking at MasterCard. They have earnings on Thursday, and there's actually a really easy way to figure this out, especially if you have Thinkorswim. It's going to give you the number that you're going to be dividing into. So looking at MasterCard's option chain, and they have earnings on Thursday. So looking at the option chain on the right, it's going to give all these percentages and this plus or minus number. So these numbers are telling us the weighted average implied volatility. So as these numbers get higher, the more these options are pricing in. Now to figure out exactly how much they're pricing in, we're going to look at that plus or minus number. We're just going to divide that number by the price of the stock right now. So in this case, I'm taking the weeklies, the July 30. So the first one up here, I'm taking 17.4 and I'm dividing it by the price of MasterCard right now. So this is going to give me a quotient, and then I'm going to multiply that by 100, and that's going to be a percentage. In this case, this percentage is 4.4%, and this is telling us by Friday we are pricing in a 4.4% either way on the option chain for MasterCard. So the implied volatility here is sitting around 50%. And as that number goes higher, so does the percentage that you will be pricing in. So to give you guys another example, let's go over and look at AMC and what their option chain is pricing in for this week. So we're looking at that plus or minus number again over here on the weekly option chain. So looking at 6.45 here, and I'm going to divide it by the current price of AMC. So 6.45 divided by 40.16, then I'll multiply that by 100, and that's going to give me 16%. So that means this option chain is pricing in a 16% move on AMC this week. So as you can see, these stocks that have a lot more risk have a lot more implied volatility, thus they're pricing in a lot more on their option chain. So I hope you guys are able to see the correlation there, and you're able to use this easy tip to figure out what is the option chain pricing in. And say you want to play a company's earnings and you want to go in a certain direction, say you want to play MasterCard's earnings, you have to make sure that you agree with what the option chain is pricing in. If I agree that MasterCard is going to move more than 4% by Friday, then I'm going to be playing the option chain there. Now for AMC, if I don't think that AMC is going to move 16% by Friday, then we may look at shorting options or collecting premium or doing credit spreads on these sort of stocks that have a lot of premium and you don't agree with what the option chain is pricing in. A lot of people actually make their living off of doing credit spreads and just figuring out where high premium is and just selling short on options. Now, whenever you hear the term IV crush, that means say the 4% that we are targeting on MasterCard here, if it doesn't hit 4% but it still goes up, people are going to be like, why is my call option not up? It's not up. That's because the option chain was already pricing in a huge move, and that is going to thus lead to IV crush, meaning you're going to lose money on calls even though MasterCard went up because it didn't go up enough. So understanding what your option is ensuring, making sure you understand what it's saying and what you get from it is key, especially as we're going into the rest of earnings season. So also understanding the implied volatility, all these option makers are seeing that, people are going to be excited about earnings. It's going to run up the premium before earnings. So you may have a nice trading opportunity on a lot of these stocks pre-earnings as the option chain runs up its implied volatility. We like to call those pre-earnings run-up plays, and we usually usually like to buy more than one contract on those, and we look to sell one of them to make the other free as we hold it into earnings. So hopefully we answered your question in the Discord, and hopefully you guys learned something today. And that wraps up this episode of Tradeflare tips and tricks. If you enjoyed the video, if you gained value, make sure you hit that like button and don't forget to subscribe so you don't miss out on any live or educational content. If you're looking to join our premier trading Discord, check out the link in the description below. Join our Discord and get half off your first month of Tradeflare Pro using the promo code TFPRO2021. And don't be mistaken, we are not financial advisors, nor do we claim to be. The stock market is risky, you could lose money, so use all the information inside these videos at your sole discretion. As always, you cannot forget that time is your most valuable asset, so quit wasting it. Get up, get out, and go get it, my friend.